Hi, my name is Ruhan Nalamati,
And my name is Saiabhiram Akkaraju.
and we're from Novi High School recommending Abbott Laboratories as a strong buy with a current price of $109.30, a target price of $151.70, representing a 38.8% upside.
As a quick overview on Abbott, they're a diversified global healthcare leader operating in 4 core segments. The first is the medical devices segment, which is Abbott's largest and fastest growing segment, anchored by the Freestyle Libre continuous glucose monitoring system. The second segment is diagnostics, which contributes 22% to revenue. This is where Abbott makes laboratory instruments, and their main revenue driver is the Abbott Alinity platform, which has over 100,000 units installed globally and generates significant recurring revenue. The third segment is nutrition, which makes up 20% of total revenue. There's 2 key products. The first is infant formula, which is backed by government WIC contracts, and the second is adult nutritional products such as Ensure. The fourth segment is established pharmaceuticals, making up 12% of revenue, where Abbott sells medicines to emerging markets such as Latin America, Southeast Asia, the Middle East, and Africa. Our investment thesis goes as follows. We rate Abbott Laboratories as buy with a target price of $151.70, and our recommendation is driven by the following key principles. First, Abbott's attractive valuation with its 38.8% upside. The second is high switching costs and high lifetime value segments, as anchored by Abbott's hospital infrastructure, which lasts for decades and generates significant recurring revenue. The third is Abbott's Apple model for AI ecosystems, in which they have a closed data flywheel, giving them significant competitive advantages and insights. The fourth is multiple near-term catalysts, which will allow Abbott to expand into new markets and generate significant profitability on several product lines.
We're going to start off by looking at an industry analysis. Abbott is active in a lot of industries, but the 3 most important markets for them are firstly their CGM or continuous glucose monitoring market. That's priced at $13 to $14 billion and is growing at a fast CAGR of 13.5%, meaning it's going to be a $50 billion mark within the next decade. And Abbott is poised to capture most of that growth because they're already the majority shareholder in this market, and they have the high switching cost products of any other competitor within this segment. Looking at the liquid biopsy subsegment of the cancer diagnostics market, that's priced at $8 billion, but it's growing rapidly with a 17% CAGR, meaning it's going to be a $27 billion opportunity within the next decade. The shift in this sector is mostly because physicians are wanting more non-invasive treatment routes, such as liquid biopsy cancer diagnostics. Abbott is making sure to capture most of this growth by acquiring Exact Sciences, which is a leading product acquirer in liquid biopsy products. Finally, we're going to look at the electrophysiology or PFA pulse field ablation market. Right now it's $2.5 billion, but it's growing extremely rapidly with a CAGR of 35.2%, meaning in the next decade, it's going to be a $10 billion market that Abbott is capturing the growth of through new Volt PFA systems.
Now, looking at the competitive positioning within these markets, Abbott either operates in an oligopoly or a duopoly in each. The first in their CGM market is Dexcom as their main competitor. While Dexcom commands significant US market share with 74%, their focus on type 1 diabetics give them a much smaller market to sell to, compared to Abbott's type 2 diabetic focus and also global focus, giving them a much larger market. This is also backed by the fact that Abbott has 7 pump integrations, which means that a significant majority of hospitals have the data systems to integrate Abbott seamlessly into their physicians' work routines, generating significant switching costs compared to Dexcom's 2. Within the cancer diagnostics market, Roche is their main competitor. While Roche does significantly more revenue, their focus on genomic profiling for diagnosed patients will become a much more stagnant market compared to Abbott's early detection and screening for healthy populations. Roche's specialty target market with a focus in specialty oncology will be worth $8 billion by 2035, compared to Abbott's focus on general population screening, which will be worth $27 billion by 2035, meaning Abbott is poised for significantly more growth. In the electrophysiology market, competing with Boston Scientific, Abbott just has a much better product. While they both produce catheters, BXS produces PFA-only catheters, requiring a switch for RF catheters for surgeons. Abbott has gone and created the technology to combine both into a single catheter, reducing surgical workflows and generating significant switching costs. We can also see this in valuation, where BSX has a 48 forward P/E and Abbott has a 24 forward P/E, allowing investors to capture this much better product for a lot cheaper.
And these competitive advantages in important markets show themselves in their financials, as a financial analysis of Abbott shows that they're healthy. And we've shown that through 3 key metrics. The first is going to be their gross profit margin of 56.5%, which is 9% higher than the industry average. That's representative of their pricing power and their scale of production. They can charge more because they have higher switching costs and better products. Looking at their ROIC, it was already solid in 2022 at 13.8%, but has expanded to 21.2%, and that reflects their shift towards high-margin medical device segments and shifting away from lower-return nutrition-based segments. It also shows us that they know how to make a return on their investments and understand how to drive their profits forward in the future. Also, finally looking at their profit figures for the ending of 2025, which is $24.4 billion, we can see that this figure was important specifically because it's higher than it was in 2022. 2022 was a year that Abbott made a lot of one-time revenue off of selling one-time COVID tests, and this made the revenue in 2023 and 24 seem significantly smaller. The fact that they beat this figure in 2025 shows us that they finally found their way and understand how to create scalable, repeatable profits that will grow in the future. And they've done this through their three key revenue drivers. The first is going to be their growth in their Freestyle Libre franchise. As we already discussed, that's their CGM devices franchise. It has high switching costs, but also a new opportunity with Medicare expansion that leads to more demand for the product line.
The second key revenue driver is the return on the Exact Sciences acquisition. Exact Sciences does $3 billion of revenue annually, but that will grow to $5 to $6 billion by 2030. Combining this with Abbott's technology, you get the best in-class screening portfolio. And Abbott's wide distribution network of 160 countries unlocks an international market for Abbott to grow revenue significantly in this segment.
Finally, we're going to be looking at their products in electrophysiology. We already talked about their Volt PFA and TactFX Duo, revolutionary products, but there's a new opportunity that arises in January 2026 where the Center for Medicare and Medicaid Reimbursements now reimburses electrophysiology procedures. That adds a massive new revenue stream to the market that hasn't been priced into the stock just yet.
Now, looking at ESG and AI considerations, Abbott has three key ones that give them a competitive advantage. The first is their strategic management structure, where 100% of corporate officers are compensated based on sustainability targets. Under veteran CEO Robert Ford, Abbott has met their 2030 sustainability plan targets 5 years early, specifically in supply chain resilience and employee retention. Looking towards employee retention, their Freedom to Save program has resulted in significant retention because Abbott invests in PhD level talent retirement at a much greater rate, allowing these candidates to pay off their student loans. It's already led to a 19% improvement in PhD level talent retention.
Our second ESG consideration is going to be Abbott's strong community initiatives. They have a $45 million annual investment into a malnutrition center to build clinical infrastructure in underserved markets, and that's to give them preferred partner status in countries like India and Rwanda. In India specifically, that's allowed them to work with 93 plus healthcare centers and impact over 10 million patients just by 2026. The Future Well Kit is also a foundation that has served 35,000 hours of nutritional education across 10 different countries.
The biggest AI consideration is the Apple model for their AI ecosystem. Libre Assist uses generative AI to predict glucose spikes before meals for patients. It's been trained on 7 million Freestyle Libre users, generating a data flywheel that allows Abbott to be vertically integrated. They control hardware, software, and AI in all the problems they seek to solve. In addition, the Ultron 2.0 model for AI imaging has reduced cardiovascular surgery times by 30% in clinical trials. Combining this with Epic EHR integration, Abbott gets 280 million more patients to add to this data ecosystem, which allows all products to be better.
And all of these considerations have been factored into our valuation for Abbott. We've done a DCF analysis that revealed that their intrinsic value per share is $151.70. Again, that represents a 38.8% upside from the current price, and the reason for that large price discrepancy is because in the final quarter of 2025, the market actually punished Abbott stock because they had a sharp decline in the revenue in their nutrition segment specifically. However, we believe that's an overreaction for two reasons. The first is that Abbott is currently curbing their losses in their revenue in their nutrition segment through two ways. The first is going to be the way they're introducing their new GLP-1 and totality segments that are related to GLP-1 users. But more importantly, Abbott's growth in the future is not going to come from nutrition segments. Instead, it's going to come from their high margin device segments, such as expansion in the CGM market, their new PFA market entry, and their acquisition of Exact Sciences. These new product revenues are going to hit their financial statements in 2026 and 2027 and propel the price back up to its target.
Now, obviously, no company is perfect, and Abbott has their fair share of investment risk. An investment risk for the CGM industry is the fact that GLP-1 demand is increasing. Products like Ozempic have sparked market fears that people won't actually need CGM products. But when doctors go to prescribe pre-diabetic patients with GLP-1 products, they prescribe them in combination with CGM products, allowing Abbott a unique opportunity to gain significantly more revenue. And this has been seen in diabetes care, growing 19.3% in Q3 2025. Another significant investment risk is the fact that NEC litigation can result in costly payments. Abbott's defense right now is doing a great job at stalling plaintiff momentum, but in the worst case, there's $6 billion in free cash flow can absorb the worst case payouts and leave Abbott still profitable. The last investment risk is China pricing pressure, reducing medicine costs by up to 60%. However, while this will tank margins, 1,500 new hospital contracts in India and Southeast Asia will generate significantly more revenue and still result in a bolstering Asian market.
So to summarize our investment opportunity, we're rating Abbott Laboratories as a strong buy with a target price of $151.70 due to its diversified growth opportunities, strong product pipeline and product ecosystems, and its attractive valuation. Thank you.